FASB Expert Series. Webinar will be focused on ASC 842, and we're going to share some of the practical things that we've experienced in our lease projects, in some areas that we believe will be helpful for you as you go through your adoption journey, or at whatever stage you're in if you've already adopted the standard. My name is Michael Cahill. I'm a managing director in our Washington, D.C. office. I have worked with the individuals that will be on the webinar today, and let me introduce them briefly. Helen Mason, a managing director out of our Denver office. Todd Follett, managing director out of our Dallas office. And Craig Rawlings, a senior manager out of our Washington, D.C. office. So thank you each for joining us and for sharing bits of your client projects and your experiences with ASC 842. We're certainly looking forward to that. So we hope you're all well, and we will start today with a few key reminders, some housekeeping items for you to be aware of. Riveron's webinars are all kept on and available on our website, riveron.com, past and upcoming. Please look there for the recordings as well as the other thought leadership pieces we have available. In order to earn CPE today, you will have to successfully answer 4 polling questions. They will pop up in the Zoom browser. Please turn off any pop-up blockers if you have those on, so the polling questions can be answered timely. During the webinar, if you have any questions, please use the Q&A function. We will respond to technical as well as content-related questions you have, and if we don't have time at the end of the webinar, we'll follow up with you on any content-related questions. Webinar evaluation forms and CPE certificates will be emailed to you, typically within about a week of the webinar. The on-demand video is available, however, CPE is not available on the replay of the webinar. Your follow-up email will include access to this webinar recording as well as the deck, the ability to join our webinar mailing list to receive future invites, and presenter contact information. With that, we'll begin the session with our first polling question. How many leases do you have in your lease portfolio? A, 1 to 50, B, 51 to 100, C, 100 to 500, D, greater than 500. And I think, we'll get into a little bit about the size of your lease portfolio and how that may impact you within the context of 842 throughout the webinar today. But the thing that we've seen that's really, I think, impactful and for you all to understand is that there's really 3 key components within the context of adopting 842. And one is getting your leases, getting your lease data. Typically, they're not centrally managed, and it's dispersed across the organization. So getting that information can be a challenge. So that's point 1, getting it, normalizing it, getting the data out of contracts, PDFs, spreadsheets, upstream asset management systems. And then it's making the accounting policy elections. So there's a number of decisions, there's a number of accounting decisions that have to be made. And then finally, it's how are you going to track the leases and account for the leases on a go-forward basis. And some companies have chosen to use a spreadsheet model that they've built, or they've worked with others to build. And many have looked at external software partners to help with the accounting process. So we'll touch on those things today, but over the hundreds of projects we've done in the lease space over the last 4 or so years, those are the 3 rather key areas that we've seen a lot of effort. So it looks like the portfolio size of our participants today is ranging with maybe the weight on the lower side, 1 to 50. So I think that's pretty much what we expected with a lot of private companies sort of feeling the waters as they move closer towards that implementation date. So the first thing we'll talk about today are changes and updates with 842 and some of the things that FASB's provided in terms of relief. Todd Follett's going to cover that for us. So Todd, please jump in.
Yeah, thanks, Michael, and good morning to everyone, and thanks for joining us today. It's been a while since we've dug deep on the LEASE standard, so we thought it might make sense just to spend a few minutes updating everybody on what's gone on over the last year and some proposed improvements that are out there related to the standard. So the first update came back in April 2020 at the onset of the COVID pandemic. You don't need to tell anyone that it was a time period when a lot of businesses were shut down and struggling to determine how to cover basic cash flow needs. And so this led to a lot of companies approaching landlords and requesting concessions to their existing leases. Under the current guidance, if the concession is beyond the enforceable rights and obligations of the contract, the concession would generally be accounted for as a modification of the original contract. So you'd have to reset your lease accounting, which means if you're under 842, you'd essentially have to start over, reallocate your consideration, update the discount rate, reconsider lease classification, and update the accounting for every single lease that's impacted. And clearly, this could be a really, really large lift for anyone with a sizable lease portfolio. So the FASB came out in April to address questions that were specifically posed to it related to concessions granted as a result of COVID-19. And the result from the FASB was that a modification guidance that was written in both 840 and 842 was generally geared towards routine changes in terms and conditions of contracts that were negotiated between parties, and not changes driven on a global scale by macroeconomic situations like COVID-19. So as a result, the FASB provided entities an option to elect an account for concessions related to COVID-19 as if the enforceable rights and obligations provided by the concessions exist in the original contract, as long as the concessions do not result in a substantial increase in the rights of the lessor or obligations of the lessee. And this point in bold is really important. So let's try and make it simple here. So if you approached your landlord and asked for a 3-month rent deferral in exchange for a 3-month extension at the back end of the lease, it's likely that your obligations didn't substantially increase and you'd probably qualify for this election. However, if you asked for a 3-month deferral and your landlord came back and agreed to it as long as you extended on the back end of your lease for 12 or 18 months, this starts to look a lot more like a substantial increase in the lessee obligation, and as a result, probably does not qualify for the election. So in this case, unfortunately, you're probably stuck with modification accounting and have to reconsider all aspects of the lease as a result of the modification event. But let's pretend that you did qualify. So if you do qualify, you have 2 options for how to qualify for the modified payments. And the first is to treat the modified payments as variable lease payments, which would flow straight in your income statement as in-period adjustments. So as an example, let's say you had an operating lease with straight-line rent of $1,000 a month and you negotiated a 3-month deferral of payments in lieu of 3 $1,000 payments at the back end of the lease. So in the month of your deferral, the 3 months of your deferral, you'd continue to recognize the $1,000 straight-line number, just like you'd recognize across your entire lease, and you'd treat the rent holiday as a credit to rent expense in the period of the deferral. So during that 3-month period, you'd have $0 in lease cost. And then you'd have incremental variable lease expense at the back end of the lease for the incremental 3 months that you extended. The other alternative is to continue to account for the concessions as if nothing had changed, meaning any deferred payments are simply hung up on the balance sheet as payables that are separate from the lease liability until the cash is remitted to the lessor. So in this situation, the income statement is unaffected. You just hang up the payable on your balance sheet and then release the payable when the cash goes out. So in the example we just covered is a very common example. There's obviously a lot of other possible situations that we haven't addressed. However, in the interest of time and being able to touch on everything else we want to touch on today, I wanted to cover 2 more important points to consider as you address lease concessions provided to COVID-19. The first is related to disclosures. Companies are going to need to consider additional disclosures to your 2020 financials to provide financial statement readers the information necessary to understand the elections and financial statement impacts related to COVID-19 concessions. And second, I wanted to highlight that the FASB has been clear that entities should use reasonable judgments in assessing whether leases qualify for the election, and that the evaluation criteria companies use should be consistently applied. So there's no bright line test to determine if concessions substantially increase rights and obligations, those key terms that were highlighted earlier. And meaning it doesn't say whether you should consider only remaining lease payments or all lease payments in your analysis. It also doesn't say whether cash flow should be discounted or not discounted. So companies have some liberty in applying judgments. You just have to be sure to apply them consistently and document the assumptions used. So in addition to COVID-driven impacts of 842, the FASB has been focused on targeted improvements to the standard now that public companies have been operating under the new standard for almost 2 years. In October 2020, the FASB came out and proposed 3 amendments to 842 that would change recognition of cost and revenue for some lessors, better align GAAP and IFRS, and reduce the cost and administrative burden of applying the standard. The first of these improvements is related to accounting for sales-type leases for lessors. Under the current standard, variable payments are excluded when classifying and accounting for sales-type leases. So in instances where lease payments are largely variable, so for example, variable lease payments based on units produced, under current 842 rules, these cash flows would not be included in the expected cash inflows of the lessor, which could trigger a loss on day one for a sales-type lease that would then be followed by significantly inflated margins on the variable lease payments earned over the lease term. The proposed change would require lessors with predominantly variable lease payments to be classified as operating leases, and as a result, the lessor would no longer de-recognize the underlying asset on day one or recognize the loss. Instead, the variable lease income would partially be offset by right-of-use amortization, which the FASB better reflects the overall economics of the lease. So it essentially gets to kind of a better smoothing answer in terms of the income statement impact. The second amendment provides lessees the option to follow IASB guidance and remeasure lease liabilities and right-of-use assets solely due to changes in indexes or variable rates. Currently under ASC 842, any cash flow changes resulting from changes in indexes or rates unknown at the lease inception date are considered variable lease payments and taken as in-period adjustments, and the lease liability does not get reset upon these changes. Under IFRS, the right-of-use liability and the corresponding assets are remeasured anytime indexes or variable interest rates change. So companies that are required to report under both U.S. GAAP and IFRS are currently forced to maintain 2 sets of books to comply with the differences in the standard. With the proposed amendment, companies could adopt an entity-wide policy election to follow the IFRS guidance on remeasurement solely due to changes in interest rates, which would alleviate the burden of dual tracking. The final proposal is intended to provide relief to lessees who lease multiple assets under a single master lease agreement. Under the current standard, a partial termination of a component of a lease triggers a lease modification for all components. So for example, if an entity has a master lease agreement for a fleet of 100 vehicles and later agrees with the lessor to early terminate 25 of those vehicles, both the lessee and lessor are required to apply modification accounting to the remaining 75. Which again means reallocating consideration, redetermining discount rate, and could affect the classification. Stakeholders have asserted that terminating one lease component in a master lease agreement should not affect the lease accounting of the residual assets if those assets are unaffected by the change. Therefore, the FASB has come out and proposed an exemption from applying modification accounting in situations where early termination of a lease component does not economically impact the remaining lease components. So in summary, all these amendments sound fairly reasonable or attempts by the FASB to improve the visibility in leasing transactions and the burden of applying the standard. So what's next? The deadline for feedback in the amendments is December 4th, and after that, the FASB is going to determine the effective date. The transition guidance is obviously going to depend on where you are in the process. So if you have not adopted 842 yet, you're just going to follow the transition guidance that's provided within 842. If you have adopted already, then the entity can elect to apply the changes either retrospectively to the date of adoption or prospectively to leases that commence or are modified on or after the effective date of the proposed changes. And these transition elections are available on a per issue or topic basis. So that's what's new with the FASB related 842 in 2020. Michael, I think it's time we're ready for our next polling question.
That's right. Thank you, Todd. Polling question number 2. how is your current lease portfolio being managed? A, we're expensing all leases currently and need to build a better process. B, a spreadsheet is maintained with our lease information. C, we use a lease administration software. D, don't know. So while we wait for that, and as we're looking to head into year end, can you take a moment and comment on what companies need to be doing as they prepare for their 2020 audits?
Yeah, I think, first and foremost, I'd probably go back to, what you did back in the spring related to COVID. If you had things that were potentially concessions or you skipped on payments related to leases, I'd start to get your house in order related to that. First and foremost, you got to understand whether a formal concession was granted and gather support for the agreement between the lessor and lessee. If there's no agreement from the lessor and all you did was just kind of skip payments, then the accounting for leases doesn't change, meaning you don't have an option of actually taking the credit to straight line rent for the missed payments. Second, if you did have an agreement that was agreed upon, then make sure you complete your evaluation of whether the concession qualifies for the relief, meaning that there was no substantial increase in the right of the lessor or obligation of the lessee, and document how you arrived at that conclusion. Remember, there's some liberty there, but you just have to be consistent in your application. And then finally, the last piece is probably just make sure that that you're supporting lease schedules and commitment footnotes, et cetera, are updated based on the final accounting, right? So look at your contractual commitments, make sure your P&L aligns with any elections that you're allowed and have chosen to make.
I think, and on top of that, I think just the timing, right? I think the message that we've been trying to relay to clients is start early. Look at that stuff, but start early. Exactly. Thank you, Todd. Appreciate that. So it looks like spreadsheets winning out here in terms of poll responses. Folks are using a spreadsheet predominantly, with a good chunk, over 25%, using lease administration software. So good feedback. Thank you. From here, we'll jump next to some of the challenges, but also some of the practical practices that we've seen that have been effective with our clients. Like I said, we've done hundreds of these. We've been working with the lease standard for going on 4 years. So we want to share some of the knowledge that we've experienced so you can avoid some of the headaches. So Helen's going to cover this section, and Helen, jump in.
Perfect. Thanks, Michael. Good morning, everybody. So as Todd discussed, the FASB has continued to push out the adoption date for private companies, as well as proposed the discussed concessions. So in that vein, we thought it would be helpful to segue into some of the challenges that companies have run into and some of the key lessons that we've seen from our projects, namely from public companies. So, one of the main things here is the importance of the initial project planning. Involvement from the right folks of your organization, many of whom, surprisingly, I think, will be outside of the accounting department. They need to understand kind of what you're trying to accomplish, and it's not as simple as just asking them, give me the leases that you have that exist today. Second, data aggregation. So, prior to performing your completeness procedures, which we'll get into next and spend some time on in the upcoming slides, just aggregating the data and documenting your process there is important. So completeness, this is not the last time you're going to hear this today or into the future as you discuss this topic internally as well. With the fundamental change in the definition of a lease, it really calls into question many types of agreements that under ASC 840 you may not have considered in your population. So that completeness and that analysis as you adopt a new accounting standard is paramount, especially from an audit standpoint as well. The bar is high for proving out your completeness exercise, documenting those procedures. So like I mentioned, with the change in the definition of a lease that comes with ASC 842, there's many agreements that exist today that might not have historically been considered a lease and would now have an embedded lease. Some of those examples quickly are, vendor agreements, service contracts, sometimes long-term supply agreements, just to name a few. And admittedly, this is usually a pretty subjective analysis, which requires, a lot of, documentation and brain damage behind, meeting, some of these documentation requirements. Next, determining your appropriate go-forward tracking mechanism, and that's really a process and a mechanism. So, you want to avoid having to complete this cumbersome initial completeness exercise more than once. And for those, on the phone from public companies that have lived that pain, or those, private companies that have to meet, IFRS standards, that the completeness exercise can be fairly painful. And so really thinking through on day one, how do we kind of maintain all of the documentation we now have on a go-forward basis, and how do we avoid having to go through that process at that level of detail again. So lastly, the new and robust processes required post-implementation. So, from a control standpoint, there's likely, new controls and processes that you're going to have to implement to first, verify, one, you've appropriately adopted the standard. Again, a high bar when you're talking about a new accounting standard. Secondarily, how am I going to maintain compliance going forward? This is a little bit harder than maybe an ASC 606 adoption, where it's pretty easy to keep tabs on new revenue contracts. Kind of going back to that embedded lease concept, really keeping a tight eye on any new contracts and agreements and how you're going to identify post-implementation date, where some of those, embedded leases might lie, and how do you plan on keeping tabs on that into the future. So after reviewing what we've seen and heard in practice here, wanted to show you just briefly what the SEC has been focusing on as well for some additional context. So some of the recent SEC comment letters have focused on, three main areas. So one being lease identification and classification. So with the largest focus being on the first steps of the ASC 842 adoption process, lease identification and classification. This is an area where we've seen the most comment letters, and in addition to that, the most kind of rounds of comments back and forth with the SEC. This has been one that's been very hard to clear with kind of just an initial response back to them. Adoption disclosures, I think, frankly, the SEC is probably learning right alongside everybody else, and really has just been asking some probing questions around maybe some more commentary or some more clarification in the disclosures that they're seeing in some of the large public companies. Non-GAAP metrics. So the SEC also noticed and commented when issuers were using non-GAAP accounting measures to exclude the effects or impacts of new accounting standards. The comments really addressed some adjustments that folks were disclosing that excluded lease related expenses. So, I think some companies noted, modified metrics, pre and post adoption of ASC 842. I think, many public companies know non-GAAP metrics are, a big SEC comment area in general. So not totally surprising here when we think about that from the ASC 842 standpoint. I do think we'll continue to see iterations of comments here as time goes on, just knowing when you think about non-GAAP metrics in general, there's just diversity in practice with public company filers many times, especially depending on what industry you're in. So just some examples here, industries with the most comments. So technology has been one, real estate and construction. This one's interesting. So the comments were centered on the identification and classification of a company's lease portfolio. One comment that was seen many times was related to a company's conclusion on, if it was reasonably certain to renew a lease given various, entity-specific and market-based factors. So, many of us that have lived through these adoptions before, that reasonably certain word, is a tough one to interpret sometimes. And I think, for anybody who's not gone through the process yet, determining that lease term under ASC 842 can be extremely difficult. It's subjective. Again, likely, I think we'll continue to see this type of comment, probably more pervasive as well outside of just the real estate and construction space. So manufacturing, energy, and transportation, these retailers, these were kind of the top industries that received comments to date. So, there was a theme within each of the industry, but a lot of these kind of common issues we're talking about were pervasive across industries. So, another kind of interesting thing to note when you think about SEC comments, what is the resolution timeline? So on average, when we think about just a normal SEC comment letter, outside of ASC 842, those usually take around 10 days to resolve. So, this has not been the case with ASC 842 comments. There have been far more staff follow-ups and kind of back and forth, and it's taken, much longer to reach a final conclusion, with the average being more like 83 days, which, is clearly much larger than your normal kind of 10-day average. Like I mentioned before, I think, with any new accounting standard, they're really learning right alongside the large public companies. And there's just, a few iterations, to get some of these comments from them resolved. Let's talk about some of the impacts on IPO timelines. So, 83 days, that's almost a whole quarter. And so, when you're thinking about a registration statement and, that period of time can definitely delay, your IPO timeline and effective date. Another thing for private companies to think about here, and frankly, we've been actually seeing a lot of this recently with some of our projects and clients, with the amount of consolidation happening in many industries recently, there's a lot of private companies, merging with, getting purchased by public companies. So what we're also seeing is a need for, a private company who, hey, I've got till 1/1/22, this is on my radar, but not a lot of effort has been expended to date. Now you've got a public company buyer, in, doing diligence, asking questions, wanting to get a deal done and an 8K and other filings done. And you have to then adopt the standard, to align with their timeline very quickly. And if not much has been done around, this kind of gathering the data and completeness, that can be, a huge undertaking, and a public company buyer is going to expect you to do that in very tight deadline. All right, so, quick, just kind of visual here on how some of these comments have looked. Adoption disclosure, like I said, I think, there's just a lot of clarification wanted by the SEC, verification that you really have kind of met all those disclosure requirements. And the other big chunk, like I said, around identification and classification. So, knowing that and kind of seeing that chart and where the identification and classification falls, let's take a look at how to tactically address, some of these issues that we've just reviewed from public companies, as well as some of these SEC themes. So, like I said, it's probably not the last time I'm going to say completeness even now. But, identifying the population, huge undertaking here. So like we said, SEC comments have focused heavily on this, and really also audit considerations. So this is one thing that your auditor is going to ask, first and foremost, probably before you even kick the project off. What is your plan for identifying the full population? So, defining that process before diving in is key. Really kind of, again, we mentioned this earlier, getting the right folks from your company involved, getting their buy-in, making sure they fully understand, first, why you have to do this. You as the accounting department are not the ones, defining what has to happen here, having them understand really this is a new, new accounting guidance that we don't have much of a choice to adopt here. And buy-in from your external auditor, I think from the beginning, and doing your best to partner with them. If there's certain things that they might, let you know early on that they expect to see, those are just good tidbits of information, to know before you get too far down the path. Identifying all potential data sources. I mean, I mentioned a few types of embedded leases that exist. That is definitely not the full list. I think that where those embedded leases might be hiding can really vary by industry. And so kind of doing some diligence first as to where you should be focusing, where some of the risk areas there are is really important. Your current processes, likely your current, processes around leases from an ASC 840 standpoint are not going to be robust enough, to meet that, completeness test from an ASC 842 standpoint. And that's okay. But, really taking a hard look at your current process, maybe there are some portions of that process, your procedures today that you could utilize and maybe just build upon. So really figuring out, what is working today? What can I continue to do? And where are you going to have to implement new processes and procedures? And a lot of times those new processes are outside, of the accounting department. So buy-in, having folks on other teams really understanding what, part they play in this is really important, to make this as cohesive as possible. Then begin gathering data. So, what are some of the challenges to data collection? I mean, I think we all know that there's kind of just inherent risk here, but, a decentralized process, I think, is one that we see the most. Many times you've got the actual kind of agreements, the signed agreements, the pieces of paper, the data that you're trying to track down, may be divided up among, 40 different field offices across the US. Many companies, maybe that's global. So, really figuring out, how are you going to get your hands on all of that data? That can be a tough one. Again, the embedded and complex leases. really focusing on identifying where those might be, early on in the process, so that you can gather that data and you can have somebody, with that kind of technical accounting understanding of ASC 842 really start diving into some of those agreements, while maybe other portions of your team are just, doing kind of the slog of, gathering all of the data. So, what's next after you've identified the population, you've gathered the data, really there's another step here of validating, yes, you are complete, and how accurate, is the data that I have collected. So, gathering is only half the battle. You really do have to digest then what you're seeing, and validate, these pieces of information. So some validation checks, definitely not an all-inclusive list here, but just a few, that we've seen. If you've got multiple entities kind of, dispersed across the country, have you now realized that you use some of the same vendors across those entities? A lot of our clients had no idea that they're using the same vendor for multiple, of their kind of companies and entities. And so, if you've identified a lease in, let's say, subsidiary A with a vendor agreement, you've got to know, shoot, am I using that vendor on other subsidiaries? And do I now need to kind of, make sure I don't have the same embedded lease that exists elsewhere? Same thing, service arrangements. These ones can be a tough one. So even if you identify a lease within a service arrangement in one of your subsidiaries, even if that service agreement's not with the same vendor, you should really vet and make sure that you don't have similar types of arrangements, within other portions of your organization that you would need to analyze. Cleansing the data, given it's going to be coming from multiple sources. Some are going to be, unfortunately, scanned pieces of paper, quality checks, and, getting all of that data into a standardized template. That seems like a very simple task, yet, it rarely is. So, defining that template up front, that's going to change for you across the course of this project for sure, as you find new information related to your leases, but making sure once you have all that data, it's validated, you're putting it all within a standardized template. So a lot of information here. Let's summarize some of these key takeaways and boil it down a little bit. The first two items here, business process. So processes and completeness, definitely two key takeaways, here from my section. So, you've really got to determine what are your key impacts to your business processes, getting ahead of those, documenting those, communicating those to all the right folks, on day one for adoption, but also, what business process impacts are you going to have from a future state perspective as well. This is not, unfortunately, a one and done exercise. So accounting policy elections, practical expedients that are available, really making sure that you've adopted the right accounting policies, you're, utilizing expedients where possible when it makes sense for you, and again, documenting that. Give yourself credit for everything that you've done in this process. Accounting impacts upon adoption. There's a lot of changes can be depending on, your company to the balance sheet and the P&L. Understanding those, making sure your company and investors understand those. Audit considerations. There's a lot that the auditors are going to require and ask out of this process. So again, making sure you've included them from the beginning, understand their expectations, and document your processes and procedures along the way. considerations in selecting any type of IT system solutions. We see many clients implement a system just for that kind of future state tracking. It definitely makes auditors feel a lot better about the process. Other impacts, I think, one of the last things I'll add is many times there are changes to your staff and their responsibilities. So, communicating that stuff early on, understanding if there's a new role that needs to be filled, or kind of redefining certain roles within the accounting organization, to help kind of meet everything that's needed from an adoption standpoint. So with that, Michael, I think we might be up for our next polling question.
It is, and we'll touch on it. I like that because your point there was just you got to look at your staff, and what we've seen is a lot of times there's not good ownership of this process, the adoption, and then really no one's looking ahead of maintaining it on a go forward. So looking at your staff, looking at all the different pieces is critical. We'll talk a little bit about your investment here in this polling question, see how it compares to the others that respond. How much time has your company invested in adopting 842 thus far? A, we have a full-time resource dedicated to the project. B, a few hours a month. C, we did an assessment last year, probably before the extension. D, don't I have until 2022? So we'll give folks a couple of minutes to respond to that. And Helen, you covered a lot of different pieces that companies will work through during their adoption, but what are you seeing in terms of what tools or processes, or what are they doing to be successful and tie it all together?
Sure, and I think realizing the time commitment up front is a hard pill to swallow sometimes, but having somebody internally really dedicated to the project, maybe they're the ones kind of managing a third party that you've brought in. And we have seen most companies really work toward that system adoption. I think a lot of people, didn't really want to talk about that in the beginning until they really understood the lift here, and having, a centralized repository for that type of stuff with some built-in controls, I think really has been the conclusion that most folks have come to, as to how they're going to manage this going forward.
Yeah, that's a good lead into our next topic. Pretty wide variety in terms of the results. So people are all over the board on 20 or 30% across the board, A, B, C, and D, in terms of the level of effort they're applying. So not a surprise there. Okay, next we'll cover something that I think is interesting, because I think companies jump to software, and we've seen it where they jump to software as they're going to get a solution that's going to come in, and it's just going to take care of 842, and it's going to take care of the pain. And I think we've seen that. I think anyone that's implemented the standard already has seen that is not the case. So Craig, it'll be interesting to hear kind of your perspective, what you've seen on the software side. And I know you're going to touch on the cost piece as well. So this will be a really good and interesting session. We'll see what type of questions come up from this.
Great, thanks, Michael, and thanks to everyone for joining and giving us a chance to impart our experience with the standard and what we've seen during past projects. But I think one of the items I want to begin with here is stating that it's really tempting for a first-time adopter, and I think especially in the private market, to approach the new lease accounting standard as essentially a zero value add activity where little to no value can be derived from making this adoption, other than, of course, the compliance. This train of thought often then leads to, an adoption that is focused purely on the lowest cost and effort possible, just to get over the finish line. And this could lead to a misguided effort. And I'll dig into that a little bit deeper as we progress through the topic. But this approach is very much understandable, but it's not necessarily the case. So when you actually go through the adoption, and we've got a few articles that highlight this, there are some tangible benefits that an organization can have, or derive at least, from going through this exercise. So vendor rationalization was a concept that Riveron had developed during 842 adoptions, where you could go through and validate all of the vendors that you've got, evaluate the costs that you have, and see if there's any areas where it could trim. So that's on our website. The other one that I think is worth pointing out is better decision-making, increased control. And Michael, this was an article you wrote that appeared on CFO.com. So these are definitely value-add areas, and I'll explain how these actually filter into the software discussion. But purely a cost-based approach will likely incur greater costs throughout the adoption process, and this is due to the unforeseen complexities that the new standard poses. So public companies admittedly did learn this the hard way, as did the software providers. At least in our observation, many technologies weren't really mature enough to handle the complexities that a lot of the adoption presented. And it was difficult to look further on down the line and understand exactly what those complexities were. So I think it's, this ultimately caused greater cost and headache for organizations, but I really want to stress that this is a generalized statement. And although market research does suggest that it wasn't true in every case. So it's not a criticism, but since it appeared the majority of stakeholders had a difficulty with the adoption first time around, there are valuable lessons for the private sector to take heed of. So these difficulties have been highlighted in several occasions. Helen mentioned them now. She's also got a great thought leadership piece on our website from May 2nd last year. I would definitely recommend any private companies looking to adopt to refer back to those. But I think the question on everybody's minds that I'd like to address up front is, why can't we just use Excel? So, effective management of the lease accounting process requires specialized knowledge of the standard. You've got to have strong controls, and neither of these are provided in Excel. So at the very basis, that's what we need to address. So talking through this a little bit greater, we're going to start off with exactly what the life cycle of the adoption is. So we have our project team, referring you to the top left of this slide. The project team during initial adoption is created. Generally, we've seen this is in the accounting function, and they're going to control how the organization is going to go through this initial adoption. They're going to gather the documents. They're going to do the data abstraction, etc. Often this is where a company like Riveron would be brought in to provide advisory and expertise in this regard. And this project team, once completed, now needs to provide for the transition accounting. So that's your accounting journal entries that are going to essentially transition you to 842. And then finally, we've got our compliance and disclosure. So in the minds of the adopter, on the left-hand side, we've got this initial adoption issue that we've got to get over, and that is a significant lift. However, it's important to point out that it's critical that we think of the day two effort. So we look further on down the road and understand exactly what this is going to look like in the future. And if I just draw your attention to the right side of the slide, this becomes a cross-functional effort. And often we found it doesn't really, the size of the organization is not always a driver behind this, because even small organizations still require some kind of input from operational teams, from legal, in order to interpret these lease contracts in such a way that they can be 842 compliant. So that becomes a large aspect of it, is you tend to draw in many departments to maintain compliance going forward. The second is lease portfolio activity. So now we're going to start to talk about where the lease software comes in. With this lease portfolio activity, I'm referring to where there's disposals, there's renewals, there's modifications, and all of these have an effect on the accounting, the ultimate output of the system. And where Excel does fall short is where you have instances where you might even only have something as small as 6 leases, but if you're modifying all 6 of those leases, you're going to land up with many of these different spreadsheets trying to calculate what the ultimate effect is and the journal entries to input into your accounting system. And to give you an analogy, a colleague of mine and I were engaged on a project where the client had 6 leases. There were 6 lease agreements, fairly straightforward. And we had advised the client to perhaps pursue a lease accounting system rather than Excel, but they were very cost conscious, and understandably so, and they decided they just wanted the Excel model for initial adoption. So we went ahead and we provided the Excel models for the initial adoption, which we've done for many other clients. But there were a few auxiliary aspects to that were very important. And unfortunately, this talks to the cross-functional effort. The accountant didn't realize that these leases had not only been modified, but the company's board intended to change fiscal calendars. So they wanted to go from a calendar year to a 445. Both of these had significant impact on the accounting. Now, in the one instance, you would be able to just change, within the accounting software, you'd be able to just change the configuration to change the fiscal year, and the system does the rest. The second is where you've got the modifications. Again, the system enables you to go through the modification process and produces the results. In Excel, that required us to produce another dozen spreadsheets to prove out the end numbers that we were going to provide to the auditors. So it was, you know, quite a lot over budget, not quite the way we would really advise our clients to go through this process. So just from that aspect, it does highlight where the software can add value. And then finally, exactly with initial adoption, we've got compliance and disclosure. So, you know, that just talks through exactly where the software can add value in producing the journal entries, reducing the knowledge burden on the team. Remember that the software providers often building controls to make sure that the compliance is there from the user, whereas Excel doesn't quite have that. And then finally, to accelerate audit readiness. So moving on to the next slide, and this I just want to briefly touch. I'd like this iceberg analogy just to illustrate the kind of effort that the adopters have to go through. So success really needs to be viewed holistically. So this is an understanding that the software does not provide all the measures of success. And success is obviously measured in several aspects. It's not just cost, it's also reduced time spent on the team, reduced headaches for the team. And really what we're seeing here is that 30% is provided by the software. Again, please understand this is a generalization, and software is critical in producing entries, automating IBR applications, which is, you know, very significant. You want that to be an automated process, and then applying classifications. Auditors are always going to have a look and see if this is an operating or a finance lease, and they're going to scrutinize that. But it must be highlighted as well that policy, process, procedures are going to alleviate a lot of the burden down the road, and how these interact with the software. So this would be a transition memo up front when you do the adoption. It's desktop instructions to ensure that clients are following the system directions as they should. And then finally, to make sure that workflows and standard operating procedures are in place so that the users understand what's expected of them. So I think just turning our attention to basic market segmentation. And this is, I think, one of the critical areas where it's difficult for customers in the market to understand exactly what they're looking at. So we decided we would get together and discuss what kind of elements we see within the basic market segmentation. And we thought that we could break it up into 3 general buckets using criteria that you see on the left of this slide. And this is a generalization, so it's not true in every case. We couldn't recommend strongly enough that discussions with the software vendor, discussions with the auditors are going to be very important. But this just gives you a flavor for exactly what to look for. So at the very top here, your transition journals are going to be the most important element. And that is something that is offered by the majority, if not all, of the lease accounting systems. Integration requires a level of sophistication and technical prowess. So the cost is a little bit higher. We tend to see that with enterprise systems where they do need to integrate a little bit more with their ERPs. Scalability is critical. Understanding where the company is going. So just for any private companies that might be on this call that are thinking of an IPO or growing fairly quickly, scalability is important. And by that, I mean, can the system handle a greater data load? Can it process more? Can it provide greater levels of reporting as you grow? So that would be scalability. Multiple currencies and IFRS and US GAAP, that's not really mutually exclusive, because with multiple currencies will come additional burden of requirements in terms of reporting. So that's typically only for your international operations, where companies are needing to report in IFRS. And then finally, the lease administration. And this is actually one of the more interesting ones, because a lot of these companies were built originally on administration and on lease management, not necessarily the accounting. And they've actually horizontally integrated into the accounting and developed expertise in the accounting. So these are, a lot of the legacy systems are actually very robust in terms of their capability of how to handle the lease administration. Finally, I just want to get into some cost expectations. Again, I want to just highlight that software pricing can vary, and it's not very often published either. But just breaking it again into these three critical buckets and some of the drivers behind the cost. So what I've got here is lease agreements, the number of them, asset types, and location, and that drives the different tiers of the pricing. So these slides will be sent out afterwards. Riveron's team will always be happy to speak with anybody who'd be interested here. But I just want to highlight these as three typical buckets, and just to highlight that also, the software providers have tiered pricing. So often they capture the value to the client by tiered pricing to reflect the size of the portfolio. Finally, I just want to address one aspect that Riveron has developed a competency in, and this is for clients that have most likely adopted, but in terms of using auxiliary technology to assist with this process, often you've got, and a good sample use case of this is with lease accounting. Riveron has developed analytical tools, and these analytical tools provide an extra layer of reporting for our clients, where the reporting coming out of the system might not have all the information that's needed for management reporting and systems within the organization. And we've developed a few analytical tools that just prevent the need for the extra work done with Excel spreadsheets after the fact. I don't want to spend too much time on this slide, but this is just one extra item we'd like to highlight. And Michael, I think with that, we need to move into our final polling question
Yes.
just before we conclude.
Yep, let's do it. Thanks much, Craig. In what stage is your organization with regard to the adoption of ASC 842 and software selection? A, haven't started planning for it. B, we started to research the available options, but we're not sure. C, have already adopted and are using a lease accounting software. D, we plan on using something like Excel. So we'll just wait for a minute. I think you all touched on it, but Craig, maybe you could just quickly highlight, maybe within the context of software, since we just covered that, what are the auditors saying? How are they touching on it?
Michael, the auditors, they have a very close eye. My recommendation there, engage with your auditors early, ask them what they think, and most importantly, just make sure that the software you're going for has robust SOC reporting. It's got to have the SOCs in order to send over to the auditors for them to gain comfort around the reporting.
Yeah, and maybe just we'll sneak in one question here. Helen, can you talk a little bit, just sort of what is the number one thing you want companies to know that you've seen from your work around the 842 standard?
Yeah, I think, as you get kicked off and start to digest kind of, what does an adoption really look like? The theme that comes up time and time again is, management teams just really underestimate the time commitment on this. And so, gathering and validating data, analyzing embedded leases, looking at your personnel and documenting all of those steps really ends up taking a lot more time than I think folks really ever initially, frankly, want to recognize, probably.
Yeah. I think that's absolutely true. Okay, well, I think that we're at the 1 minute late now, so I want to say thank you to everyone for joining us. I really appreciate the time, spending an hour with us. I want to thank my colleagues for sharing their expertise in this area. It's something that I know that each one of them has spent significant time on. So thank you. Stay healthy and safe, and we hope you have a wonderful Thanksgiving next week. And be sure to check back soon for upcoming webinars, and know that all of our thought leaderships are available. There's some that will come in the deck. You can see them, they're on the screen now, but access them at riveron.com. And thank you again for joining us. Have a great rest of your day.